Did you know the average traditional savings account pays less than 0.1%? That's practically leaving money on the table. Today, we'll unlock the secret to making your emergency fund and short-term savings grow significantly faster by understanding high-yield savings accounts. If you find this helpful, consider subscribing. We break down finance news like this every week. Drop a comment with your biggest question about HYSAs. All right, let's talk about where your cash should be working hardest. In mid-2026, with interest rates still offering a decent return, high-yield savings accounts, or HYSAs, are not just a good idea, they're practically essential. So what exactly is a high-yield savings account? Think of it as a regular savings account, but on steroids. The key difference lies in the interest rate. While your standard brick-and-mortar bank might offer you a measly 0.05% APY, that's annual percentage yield HYSAs, often offered by online banks, can give you anywhere from 4% to over 5% APY. That's a massive difference. Why such a big jump? Online banks have lower overhead costs. They don't need physical branches, fewer tellers, and that savings gets passed on to you in the form of higher interest rates. According to the FDIC, the average interest rate for a traditional savings account hovers around 0.45%, while HYSAs are significantly higher. This higher rate is crucial because of something called compounding interest. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger. Compounding interest works similarly. Your interest earns interest, and over time, that snowball effect can really add up. For your emergency fund, this means your money grows faster, making it more robust against unexpected expenses. For short-term savings goals, like a down payment on a car, a vacation, or even just building up a buffer, that extra interest means you reach your goals sooner. In today's economic climate, where inflation can eat away at your purchasing power, having your cash earn a competitive rate is vital. Now, let's look at some of the top players in the HYSA market as of June 2026. We've identified a few providers, consistently offering competitive rates and strong features. First up, we have Provider A. They're currently offering a juicy XX% APY. A big plus here is no monthly maintenance fees and a very low minimum opening deposit, often just $1. They also boast a user-friendly mobile app for easy access to your funds. Next, let's consider Provider B. They're right there with a competitive YY% APY. What sets them apart is their integration with other financial tools, making it seamless to transfer money in and out. They do have a slightly higher minimum balance to earn the advertised APY, so be mindful of that. Then there's Provider C. They're known for their stability and excellent customer service, offering a solid ZZ% APY. While their app might be a bit more basic, their reliability is a huge draw for many. They also have no minimum balance requirement, making it accessible for everyone. And don't forget Provider D, which is currently at WWW% APY and is a great option if you're looking for a no-frills, high-return account with straightforward online access. When choosing, remember to check if the account is FDIC insured. This is standard for most reputable HYSAs, meaning your deposits are protected up to $250,000 per depositor per insured bank for each account ownership category. This is non-negotiable. Also, consider how easily you can access your money. While you won't be writing checks from an HYSA, you should be able to transfer funds to your checking account quickly, usually within 1 to 3 business days. Opening an HYSA is surprisingly simple. You'll typically do it all online. First, choose your provider based on the rates and features we just discussed. You'll need to provide some personal information, like your social security number and address. Then, you'll link your existing checking account to fund the HYSA. This is usually done via an electronic funds transfer, or ACH. Just be sure to verify the routing and account numbers carefully to avoid errors. Once funded, your money starts earning that higher interest rate immediately. Now let's talk about pitfalls to avoid. The most common mistake is chasing the absolute highest rate without considering the provider's stability or customer service. A slightly lower rate from a well-established, reliable institution is often a safer bet. Also, be aware of any promotional rates that might expire. Always understand the standard APY. Finally, don't forget to monitor your account. Banks do change their rates, so staying informed ensures your money continues to work as hard as possible. HYSAs are incredibly versatile. They're perfect for building a robust emergency fund, aiming for 3 to 6 months of living expenses. They're also fantastic for saving for short to medium-term goals, like a down payment on a house, a new car, or that dream vacation. By strategically parking your liquid cash in an HYSA, you're not just saving, you're actively growing your wealth, making your money work for you in a way traditional savings accounts simply can't match. This is educational content, not financial advice. The financial landscape in mid-2026 presents a unique opportunity for individuals to make their idle cash work harder. This is a critical moment to optimize liquid assets, and high-yield savings accounts, or HYSAs, are at the forefront of this strategy. What exactly is an HYSA, and why does it command such attention now? Unlike traditional savings accounts, which often offer negligible interest, HYSAs are designed to provide significantly higher annual percentage yields, or APYs. Consider this: the average traditional savings account might offer a mere 0.05% APY, while HYSAs, as of mid-2026, are frequently seen in the 4% to 5% range. This difference isn't just a small perk, it's a fundamental shift in how savings accounts function. Think of it like finding a fast-flowing river for your money instead of a stagnant pond. The potential for growth is dramatically amplified. This enhanced earning potential is driven by compounding interest. Compounding means earning interest not only on the initial principal, but also on the accumulated interest from previous periods. It's like a snowball rolling downhill, gathering more snow as it goes. For example, a $10,000 deposit in an account earning 5% APY could generate approximately $500 in interest over the first year. In a traditional account earning 0.05%, that same deposit would yield only about $5. This stark contrast highlights the powerful effect of a higher APY, especially when interest rates are favorable. But with so many options, how does one navigate the HYSA market in June 2026? Several institutions are currently offering competitive rates. For instance, Ally Bank has been known for its consistent 4.00% APY on its savings accounts, with no minimum balance required and no monthly maintenance fees. Another strong contender, Discover Bank, often matches this with a 4.00% APY, also featuring no monthly fees. Beyond these, online banks like Marcus by Goldman Sachs and Capital One 360 have also been offering attractive rates, often hovering around 4.25% to 4.50% APY, with similar benefits of no minimums and no fees. These rates are subject to change, but they represent the competitive market as of mid-year. It's crucial to remember that all FDIC-insured accounts, including these HYSAs, protect deposits up to $250,000 per depositor per insured bank for each account ownership category. Choosing the right HYSA involves more than just chasing the highest advertised rate. Stability and accessibility are key considerations. While a slightly lower APY might be acceptable if the institution is more established or offers superior online tools for managing funds, it's a balance to strike. Factors like the ease of transferring money in and out, the presence of a user-friendly mobile app, and the integration capabilities with other financial platforms should also be weighed. Is it as simple to move money as it is to get a cup of coffee, or does it feel like navigating a bureaucratic maze? Opening an HYSA is a straightforward process. First, research and select an institution that aligns with personal needs, focusing on those offering competitive APYs and the desired features. Next, navigate to the bank's website or app to initiate the account opening process. This typically involves providing personal information such as name, address, social security number, and date of birth, similar to opening any standard bank account. Once the account is established, funding can occur. This usually involves linking an existing external bank account and initiating a transfer. Many institutions allow these transfers to be completed within 1 to 3 business days. When managing an HYSA, common pitfalls exist. One significant mistake is constantly chasing the absolute highest rate, potentially incurring fees or dealing with less stable institutions. For example, a bank offering a 5.50% APY but requiring a $10,000 minimum balance and charging a $15 monthly fee could negate the benefit of the higher rate. Another pitfall is neglecting to monitor the account for rate changes. APYs can fluctuate, and proactively checking for updates ensures the account continues to perform optimally. Strategically employing an HYSA can optimize various financial goals. For an emergency fund, it provides a safe haven for unexpected expenses, earning interest while remaining readily accessible. For short-term goals like saving for a down payment on a home or a significant vacation, an HYSA allows funds to grow steadily over months or even a couple of years, outpacing traditional savings without the risk of market volatility associated with investments. This approach ensures that liquid cash is not just sitting idle, but is actively contributing to financial well-being.